So in the business data analytics, as far as financial reporting is concerned, mostly, and what we have seen them focusing on is the consolidation parts, but in the group aspects, and also in the consolidated statement of cash flow. So in the previous settings, we realized they were much on cash flow, but last setting, which I've just confirmed, they were on consolidated financial statement, consolidated statement of financial position for the group. So as far as financial reporting is concerned, we are going to check consolidated financial statements, most of the one which they examined last sitting. And by extension, now I'll be forced also to come up with consolidated profit accounts, which they can bring. Then also we have to check consolidated statement of cash flow. So we have those three areas to check as far as financial reporting is concerned. So for today, I want us to start with the statement of cash flow, a consolidated statement of cash flow. If we can finish, well and good, we'll transit to the others in the next class. So allow me first to have the format of the statement of cash flow in case someone forgot that. So first, allow me to share it in the group, then I project on the screen. We check it first, then we can now go to the question after that. So let me get this cash flow. So I'm sharing this in your group as well. Then I project on the screen. So just check the group for the format. There I'm sending it so that you can print it for your own revision. But for the class, I'm going to share the screen. Good. So I'll share the format in your group for those who would want to maybe write it later or something. So allow me also to share it on the screen for our class purposes. So kindly confirm that you can see the shared so that we go through it very fast. Someone to confirm. Yes, I can see Joyce has confirmed. That is okay. So I hope others can also see it. So I want us to go through that format very fast. So cash flow, of course, cash flow will show the cash generated from operations, from investing, and also from financing activities. So when you check the format of cash flow is divided into those three, mainly three. And the format, we have two methods of presentation. The two methods we have: indirect method, and also we have the direct method of presentation. So we have to discuss all of them, and if possible, we need to do questions using the two formats, because at this level, you can be told strictly to use a particular method. So indirect, let's start with the direct method. So that is a sample of XYZ group, consolidated statement of cash flow for the year ended that period. So before the profit before tax, there should be operating, it should be operating activities. It's called operating activities. That should be up there somewhere here before the profit before tax. So when doing the cash flow, it is advisable that you start with profit before taxation. Then there are some adjustments you need to make. You know, cash flow is specifically checking the cash receipts and cash payments. So you always find that there are some items which were added or were subtracted prior to profit before tax. Some of them never involve cash outflow at all. There is no cash which went out. Also, some of them are non-operating. Operating activities are those activities which you incur on daily basis. Most of them is cost of sales, distribution, and administrative expenses. Those are the operating expenses. For income, it's just the normal revenue which we generate on daily sales. Any other item apart from those four, you have to adjust them against profit before tax. Those four are what we call operating activities: the normal revenue, cost of sales, administrative, selling and distribution. Those four. So any item which is appearing in the books before profit before tax, apart from those four, you should add them or you should subtract them, depending with how they were treated in the financial statements. So any moment the examiner requests you to prepare a statement of cash flow, you start with the profit before tax, then you say adjust for. So this adjustment, two things which I've said: you add back non-cash expenses, that is one, or you bring back items which are not non-operating expenses and income. So things like depreciation, you'll find they were subtracted before profit before tax. So the best you do is to add them back. You add them back because they were subtracted, but it is an non-cash expense. Cash flow is checking cash in, cash out. I hope that is clear. Then amortization. So once you bring, I don't want you to cram, but you can master this. Once you bring profit before tax, you add, always let's start with the depreciation. I've never seen cash flow without depreciation. Whichever level I've seen cash flow, depreciation must always be there. So immediately you capture profit before tax, please always try to add back depreciation. Then once you bring depreciation, I always say that depreciation has two close sisters. The sisters of depreciation is amortization and impairment. So quickly you add back amortization and also you add impairment. So any student who captures depreciation should always think about those two, amortization and impairment. And depreciation is the loss in value. Just to remind us, ourselves, depreciation is the loss in value of tangible assets. When tangible assets loses value, we capture depreciation. Then we have intangible assets. Intangible assets are normally categorized into two. We have goodwill itself, then we have these other intellectual properties. So loss in value of goodwill, we recognize impairment. When goodwill loses value, we talk of impairment. So in a question, the examiner might even fail completely to tell you about impairment. but they can give you two values of goodwill. So it is upon you to know that in case the two values of goodwill varies, in which case it has gone down, then the decrease in value of goodwill is considered to be impairment. Then these other intellectual properties, copyrights, brands, patents, which other ones do we have? Copyrights, patents, trademarks, all those. When they lose value, we recognize amortization. So that is how we normally separate them. So intellectual properties loss in value, you bring amortization. Goodwill, if they lose value, you have to capture impairment loss. Then we have now loss on disposal of property, plant, and equipment. Why do we add it back? We add it back because, you know, when you dispose an asset at a loss, the best we will do in the books, we have to recognize that loss as an expense. The loss must be captured as an expense. But the problem we have with that is that that expense is not an operating expense. What is an operating expense? Operating expense is the expense we incur on daily operations. Loss on disposal is not an operating. We don't incur that loss on daily operations to generate revenue. So initially, by using it there, it means it had already been subtracted. But you see that is not an operating expense. We don't incur it to generate revenue on daily operations. So what you do, you add it back to the profit. The same, gain on disposal of a subsidiary. If you gain on disposal, that is not an operating income. Operating income is the income you generate on daily operations. And more so the sales, the daily sales, or which is just when they write revenue, we always assume that revenue is the sales. So in presentation, you have to eliminate the gain on disposal because it is not an operating income. So you subtract it out. The same with investment income. Yes, there is cash inflow, but they are not operating income. We don't generate them on daily operations, so we have to subtract them. Then finance cost. Finance cost is this category of interest. Interest is not an operating expense. So you have to add it back during presentation. If you find share of profit after tax in associate or joint venture, you subtract because they are not operating income. So what you get after adjusting that to the profit. So in the question, you might not find all of them. You can even find only two. You can find the ones which are common is depreciation. The common ones is depreciation, impairment, and finance cost. Those three are the ones which are very common. Then what you get after the adjustment is called cash flow before working capital changes. Then now you give us the working capital. Working capital addresses the changes in current assets and current liabilities. So increase in current assets is always subtracted. When current assets goes down, let me pick like stock, inventory. Increase in inventory means you are buying more stock. So when you buy stock, remember cash flow, we are checking in terms of cash. So it means the cash is going out, which you have to subtract. Then decrease, you add, because decrease, for example, in stock means you are selling. So it is a cash inflow. Increase in current liabilities. Current liabilities, let me pick like payables. When payables goes up, it means you have money, but you are not paying. Madeni zinaenda juu, lakini wewe haulipi. So you have the money. Decrease in current liabilities, it means you are paying. Creditors balances are going down, it means you are paying. Then that is called cash generated from operations. So cash generated from operations is the sum of what you got before working capital, and you adjust for the working capital. to get that figure. Then you subtract the tax paid. So once you subtract the tax paid, you get now the cash flow from operating activities. Mostly, some people will also subtract. After the tax paid, a student may subtract the finance cost paid, that is interest, and even dividends paid can be subtracted from the working capital down there. There is no problem. Interest and dividends can be subtracted from operations, investing or financing, provided it is applied consistently by an entity. So there is no restriction. They can be subtracted from any. They can be argued to arise from any of those three. So if a student subtracts interest, dividends from operating activities, investing and financing, the examiner will mark it right. Because the standard IS number 7 says that they can be subtracted from either of the activity, provided that the entity applies them consistently from time to time. So you get that. Then you go to investing. When we are going to work on investing, investing is mostly on non-current assets. How much you received on disposal, how much you paid to acquire the assets. Mostly it's about that. So you will check the cash received on disposal of PPE, that is a plus. Cash paid to acquire is a cash outflow. Cash received on disposal of a subsidiary, that is a plus. Cash paid to acquire subsidiary is cash outflow. Investment income, now you add it here. Remember, we subtracted it on operations because it is not an operating income, but we add it under investment. You get that one there. Then financing is all about equity, the capital structure of an entity, and loans. So when you are on financing, you check the capital structure, the changes in capital structure, and also the loans. So financing, you check cash received on issue of new ordinary shares, dividends paid to non-controlling interest, that is the NCI, and holding company. HCO there stands for the holding company. Then I said finance cost, you can subtract it in any. So in this case, it has been subtracted under financing. So finance cost paid, loan acquisitions, you will add, loan repayments, you subtract. Then I think is that subtraction. Loan repayments should be subtracted. Then you get cash flow from financing activities, which we are calling C, commission, C. So the sum of A plus B plus C is the net cash flow. That is the net cash flow, which you have received for that year. Then you check cash and cash equivalents at the beginning, you add, then you get cash and cash equivalents at the end. So the examiner will give you those cash and cash equivalents at the beginning and at the end. So yours is to reconcile and check whether you are accurate. Then under the direct method of presentation, also you start with operating activities, in which case you start with cash received from customers, you subtract cash paid to employees and suppliers, then you get cash generated from operations, you subtract tax paid, then you get cash flow from operating activities. So the student who uses the direct or indirect, operations must be the same. That A must be the same in whichever method. NB down there, investing and financing activities are similar in both approaches. So whichever approach you use, investing and operations are the same. They only differ in operating activities. Otherwise, the rest remains the same. And that is why I've not given you the formats for investing and financing, because they are the same regardless of the method you use. When the examiner is silent on whichever method to use, I will advocate that you go for the indirect, that first format, It's quite easier to get so many marks there than compared to this other one. Then write this kidogo. It might be very important for you. The cash and cash equivalents. Write that, cash and cash equivalents. So we are not going to write it in broad, just something small about it. You say cash and cash equivalents comprises of cash in hand and bank, cash in hand and bank, comma, short-term investments, short-term investments, and any liquid assets which can be converted into cash. Full stop. Small contribution there. Bank overdrafts is treated as a negative cash equivalent. Negative cash equivalent. Full stop. Full stop. Good. So confirm to me that you have the past paper for December 2022. Kindly confirm. Past paper for December 2022. Kindly confirm so that I can know where to head next. Confirm whether you have December 2022. There was cash flow there, which I can see to be question 24. Question 24 in section 2. Oh, sorry, Joyce, I never saw your text on operating activities, but the good thing we are recording, so you will check. No problem. I hope that's okay. So Jared and Wangui has confirmed that you have the paper. So I want us to check on that question. Question 24 of December 2022. I want us to check that particular question. So be there. So allow me to read the question. It says, Bermuda Limited presented the following financial statements for the year ended 30th June 2021 and 30th June 2022. Fine. So revenue was 473, as you can see. We had cost of sales, gross profit. Then we had gain on financial assets at fair value. Also, we had investment income. Fine. Other expenses, we had administrative, distribution, finance costs, then profit before tax. Income tax expense, as you can see, profit after tax. Then statement of financial position. We had property, plant, and equipment, intangible assets, financial assets through other comprehensive income. Those are long-term financial assets. Then we had current assets, inventory, trade receivable, financial assets at fair value. Note very fast, financial assets at fair value, those are normally treated as cash and cash, part of cash and cash equivalents. Very important. Financial assets at fair value. Why should have, financial assets, these are things like bonds, bills, and the rest. So if it is short-term, if a financial asset is short-term, then it should be recognized as part of cash and cash equivalent. Then also we have cash and cash equivalents there. Equity, we have ordinary share capital, share premium, revaluation reserve, then financial assets through other comprehensive, that is equity reserve. Then we have retained profits, no problem. Non-current liabilities, we have 10% convertible loan stock, no problem. Current liabilities, bank overdraft. Bank overdraft is a negative cash equivalent. Kindly note that. So when you want to determine cash and cash equivalent, you will also consider the bank overdraft, but as negative. Trade payables, interest payable, income tax payable, then you have the total liabilities. Additional information, number 1, property, plant, and equipment held by Bermuda Limited are items of plant and equipment and freehold premises. Okay, it was plant and equipment and freehold premises. Fine. During the year, item of plant and equipment which originally cost 40 was disposed of, resulting into a loss of 6 million, charged in the administrative. So inside the administrative, there is loss on disposal of 6 million. This item had a net book value of 28 million as at the date of disposal. No problem. Depreciation charge for the year ended 30th June 2022 was 43. It was 43 million. No problem. No problem with that. Shillings 50 million of convertible loan stock was converted to 50 million ordinary share capital at par during the year ended 30th June 2022. Required, prepare the statement of cash flow for Bermuda Limited for the year ended 30th June 2022 as per IS number 7, statement of cash flows, 20 marks. So here the examiner did not restrict on which method we are supposed to use. So if the method of presentation has not been dictated by the examiner, then you can use whichever you want. But in this case, I would want us to apply the indirect method first. Then maybe if we want, we can use direct. But when not specified, it is advisable. It is advisable to go for the indirect format. So you will open your Excel sheet, which I know now that will not be possible. You will just check how we are doing it and how it should be done, because this presentation must be done on Excel. So you will allow me to open mine. You can even present it in the books, then you will capture it later. We'll capture it later, so allow me to open mine, then we see how it's supposed to be done. So kindly first confirm that you are able to see my worksheet. Just one person to confirm that you can see my worksheet. Okay, then that's fine now. So now we want to start presentation. So what you will do in this case, in the spreadsheet down here, you can see sheet 1. For sheet 1, you will say here, this is cash flow presentation, Then you will have sheet 2 or worksheet 2. Then you name it workings. So those are the workings or notes, whichever. You can write them notes or workings, whichever way you want it. Then now we need to go for presentation, in which case you just, the normal presentation, you give us the heading here. So the name of the entity, Bermuda Limited. So they are called Bermuda Limited. Statement of cash flows. Statement of cash flow. For the year ended. This is, the year is ending on 30th June 2022. So that is 30th June 2022. So you can decorate it the way you want. Those decorations are not very important, but you can decorate it the way you want, to your satisfaction. So I can have it up to there. So you can just underline the last one if you wish to. You can underline with whichever form you want. That does not matter a lot. So you will, let's have 2 columns. Sometimes we can even operate with 1 column. There is no restriction. So allow me to use 2 columns. So the 2 columns here, we have this one, shillings in millions. So shillings in millions. Shillings are in millions. Shillings are in millions. There. So up to there, we can copy paste this one here. Copy paste is called Control C, then Control V. Those ones you are now smart at. So we can have good space there. So obeying the format, we start with operating activities. So we'll have the heading operating activities, in which case this heading, you can also decorate it the way you want, in which case my decoration will be bold. Then you can also have it underlined because it's like more of a heading. Then you start now with profit before tax. Profit before tax. So profit before tax, that one has no working. So you'll just capture. So I want us first of all to use the first column. So how much is our profit before tax? I want us to make it more of a participation. How much is our profit before tax? then a minute, is asking that I adjust the screen. Jared, how will you want me to adjust the screen? Kindly. Is the screen okay, the spreadsheet? Jared, did you double tap? Are you double tapping on the other side of the sharing?
No.
Yes, double tap. Because let me ask randomly. Joyce? Veronica?
Mine is fine.
Yes?
Mine is very fine.
Yeah, so Jared, I hope you have double tapped. Jared?
Yes.
Now it's okay, yeah?
Yes.
Thank you. So profit before tax, how much are you seeing? Now that you are not muted, you can even speak it loud so that we just proceed. How much profit before tax are you seeing?
114.
114 is correct. So you will bring there 114. Then you come immediately, you write before tax, you say adjust. So adjust for. So adjust for. So we said immediately you say adjust for. What comes next? First, before, what item do we bring here immediately?
Depreciation.
Depreciation. So you give us depreciation. So in this question, depreciation was provided in additional note number 2. So in the additional information number 2, they said depreciation charge for the year was 43 million. So you capture here 43, in which case you add it. You add that amount back to the profit. Then once you have captured the depreciation, I say you should quickly think of the two sisters of depreciation. The sisters of depreciation are impairment, and amortization. Impairment is to goodwill. Amortization is to these other intellectual properties. In a question whereby the examiner is not mentioning whether it is goodwill or intellectual properties, they just say intangible. You know, all of them are intangible. When it says intangible assets, then in the presentation, you write amortization stroke impairment. It can be any when they are not specific. So I will come here. See, lazima ikwe. So you write here amortization stroke impairment, whichever. So we'll capture it here. Go to non-current assets. When you go there, you are able to see intangible assets. At the start of the year 2021, intangible assets was 50, then it dropped to 40. So it will not be practical. It will not be practical for you to come here and write that it is 50 minus 40. In presentation, here for data analytics, you must, every figure which has been adjusted, you know, the ones you have written, there was no adjustment required. In data analytics, any adjustment should have workings. Iko shida. You know, we started giving the presentation where we're supposed to do workings. So that one has no problem. In fact, that is good. It's a mistake you can encounter. So what we are going to do is just to cut the entire thing, then we take it in the space it's supposed to be. It should be under presentation of cash flow. I think after we wrote the workings, we just started. So there's no big issue. We'll just bring it where it is supposed to be. So I will do away with these two columns so that it can be nicely presented. I have just noticed that, so there is no big issue. So I was saying, everything which requires adjustment or workings you don't just do in your calculator, then you show them there. That is wrong. You have to do a working, then you integrate the two. So integration, so I will go to my workings. I will go to my workings in the other sheet, in my worksheet 2, there. Then I will say here, working one, that is W1. So W1 is on amortization stroke impairment. So just increase the speed. So amortization stroke impairment, there is no specific way you can do it. You can even write is equal to this minus this, whichever way you want. But me, I'll say balance brought down. So the balance brought down was 50. Then you skip one line, then you say balance carried down is 40. So it therefore means then you can close that. So close top single bottom underline like that. Then you say here in between impairment or amortization. So you can just write 1. So that is the impairment. Let me just call it impairment. Impairment. So the difference.
Mwalimu.
Yes, someone?
But you see the 2021.
Yes, please.
Intangible assets were 40 million and 2022 it was 50.
No.
So was that impairment really?
No. Can somebody correct Jared on that? Is everyone seeing the same? Joyce, Pauline, Rose, Steve, Vero, Wangu, allow me to be calling you Wangu. Wangu is quite familiar in my mouth. Is what Jared is saying correct? Jared is saying there is no impairment because 2021, Jared, I think you are reading it the vice versa.
Oh, that what was shared?
If you check presentation, 2021 is 50, 2022 is 40.
Okay, then now I think now it's what was shared in the group.
No,
the question then.
Because I printed it from there. I want to hear from others how you are seeing your presentation. Can someone speak up apart from Jared, how your paper is? Kindly.
Mine is fine. Mine I'm seeing 2021 has 50, 2022 has 40.
Yes, Jared, that's how it is. So I will.
Mine is the same as Jared. 2021 is 40, 2022 is 50.
Yeah. Then there's an issue. Any other person? One more? So that we can know what is happening. So what we can do very fast, can you confirm? Let me share in your group right now. Confirm with this. Let me share this in the group. I don't understand. That one can give us a lot of headache here. I hope it will be fine. Jared, can you confirm whether what I've shared is in line with what you have? Then now we can pick from there. Can you just check? I've shared in your group. It is in line with what you
Yes,
have?
yes.
It is the same. It is the same with what you have?
Yes, I think the chat on the soft copy,
Yes.
they interchange the years. Like now I'll have to change the records for 2022 now will come first, then 2021 at the end of it.
Okay.
Yeah, I think that's the challenge.
Then
They interchange the years.
I hope mine is correct because I just printed direct
Yes,
from CastNet portal.
yes, yours is correct.
Okay, so then let's proceed with mine how it is. So impairment, and also more importantly is knowing about the format and presentation, so there is no big issue. So impairment, we kindly try as much as possible for these things to be formulated, sorry. So impairment, I will have here in bracket balancing figure. So balancing figure for my impairment. Then you'll have this. So I'll say there is equals to the 50 minus the 40, which is 10. So my impairment is 10. So when I go back to this page, I have to go back to this page. I will say is equals to. So now there you will have to bear with me, because one, you know me, I'm a financial reporting person, not an IT person. So mwalimu wenyu, I'm very sure there is how it showed you how to interlink the worksheets. So mine might be different. I have to have that disclaimer. Mine might be different, but you can just use the interlinking how you are used to. If mine is fine, then you can also adopt. So I always do interlinking this way. I will say is equals to, so I want to interlink that 10 with this spreadsheet, this sheet here, worksheet. So I will say is equals to, then I go to the workings, then I click 10, because 10 is the one I want the other side. So I click 10, then also I click is equal. Then I go back to the worksheet. Then I delete backspace. I will backspace all this. I backspace that up to where I have that equal sign. Then I press enter that way. So that is how I do the linking, which you can do it the way you are used to, but that is how I do the linking. Is there anybody who wants me to repeat that? If yes, please allow me to know. Okay, then we proceed if there is no issue with that. Then we have, so after depreciation and impairment, I want you to master the flow. Depreciation, impairment, check whether there was disposal of PPE. And if yes, did we gain or we lost? Did we gain or we lost on disposal? Yes, there was disposal in note number 1. Check note 1. Check note 1. They said item of plant and equipment which originally cost 40 was disposed of, resulting into a loss of 6 million. So loss on disposal disposal of PPE So that one was said, so there is no need for you to do a working. That is 6. Remember to save your work. So we can save this. Whichever place I can save it. In exam, you will have that space. So BDA, this is BDA, December 2022. That is question 24. So remember to save our work in case of anything. So loss on disposal you add, and I did explain when we were starting why we add the loss. It must have been subtracted. In fact, they said it is an administrative, but you see that it's not an operating expense. So you add it back. So it is all about depreciation, impairment, loss. If it was again, you subtract. Once you are done with that, you go back to the P&L. We go back to P&L where we have the PBT, the profit before tax, where we have the 114. You go backwards from the profit before tax. You check for items which are non-operation. The only ones you leave is cost of sales, administrative, and distribution, and by extension revenue. Those 4, those are the only operations. They are the items we capture on daily operations. Any other item appearing before profit before tax, apart from the ones we have mentioned, if it was added, you subtract. If it was subtracted, you add back. So let's go back. So PBT, where we have 114, I want us to climb backwards. Which item are you seeing?
Finance cost.
Finance cost. So you add back. Finance cost is not an operating expense. We don't incur it on daily operations. So you bring here finance cost. That one does not require working. So you add it back. This is 17. You add it back. Going backwards, distribution is okay. Distribution is an operating expense. That is okay. Administrative is okay because what was captured there was loss, which we have rectified. So admin, you don't interfere with it. That is an operating expense. You go up. Investment income, no. Yes, it's an income, yes, but that is not an operating income. We don't receive investment income on daily operations. So you subtract it. So investment income, this one we have been given to be 6. So that one you subtract. You subtract because it is not an operating income. So you get it, you get it subtracted. Subtraction, you can use whichever form you want. So that one should be subtracted. Then after that, we have, you go backwards, gain on financial assets at fair value. Other you again, we don't need it here. It's not an operating income. So gain on financial assets. Gain on financial assets. This one also will be less, 5. So that one also you have to subtract it off. So you can leave this negative the way it is like that. There is no problem. Or if you want to get it bracketed, you just bring this comma here. Then because we are not having the zeros, we can reduce them like that. So as far as we are concerned, we are done with all the adjustments. That is how we do adjustments, students. Profit before tax, depreciation immediately. Whoever thinks of depreciation must think of amortization and impairment. After that, check whether we gained or we lost on disposal of an asset. Once you're done with that, go back to the P&L. Profit before tax, then go backwards. The items which you should not bring here is admin, distribution, cost of sales, then revenue. Any other item appearing within that space, if it was added, even if you don't know what that item is, if it was added, subtract. If it was subtracted, add back. It is non-operation. And therefore, we need to get this total because this one is going to be our cash flow before working capital changes. So let me have this underlined, bottom, single bottom underlined. So this is cash flow. This is cash flow before working capital changes. Before working capital changes. So before working capital changes, I said you don't do in calculator, then you fix. You have to formulate, which I will say is equals to the sum. So sum in brackets, then I drag from top up to there. Then I will close that. I'll close that, then I enter. So the cash flow before working capital changes, that is 179. Then now you need to bring now the working capital. So bring the working capital. So working capital, I'm going for current assets and current liabilities. Working capital must be a working. You must do a working for that. Then you integrate. Please, that one we don't have any option but to comply. So allow me to go to working straight. So that is continue saving your work. So this is working 2. This is working 2. Oh, and sorry, you need to show like working 1 on impairment. I was to show here amortization stock impairment W1, that is working 1. You have to show where I'm supposed to get that. So you have to indicate here working 1. So this is working 2. So working 2 is working capital. Working capital changes. Working capital changes. So working capital is the current assets and current liabilities. Current assets and current liabilities. So I will have here presentation. The way you want to present it is up to us. Nobody restricts you. So check current assets, inventory. And I've said you can present it the way you want. Inventory. Then we can have trade receivables. So just write receivables. Receivables. Then we have financial assets. Those are cash equivalent. Cash, you don't bring it here. In fact, in Akwanga, inventory, receivables, and payables. By extension, prepayments and accruals. So go to current liabilities, bank overdraft, no? So you will bring payables, payables only. There is nothing. Interest does not come here. Tax, you don't bring them here. So these are the working capital components. These are the mostly they are those ones, those 3. I don't know why payables went there. Let me cut and bring it here. Yes, those ones there. So now, how will you, what are you trying to check? We are trying to check increase or decrease in the working capital components. So how will I get increase or decrease? I will check the balance brought down, then in between will be increase stroke decrease. Increase stroke decrease. Then I will have the balances carried down. So balance carried down there. So it will just be a comparison. It will be a comparison. So I can close that one. Whichever way you close it, doesn't matter. So brought down inventory is the 2021. So 176. Receivables is 87. I hope you are seeing that with me. Payables brought down is 100. Is 100. Then let's capture the carried downs. So carried down inventory is 123. Then receivables is 95. Then payables is how much, students? Payables is 156. 156. So the differences here, you'll say is equals to, for example, you can take whichever. This one here. But this one here will not rank. It will depend. Inventory, that it was 176, then it went down to 123. So that is cash inflow. It means we sold some stock. And when we sold, is a cash inflow. So it should be positive. There you have to be keen, because if you interlink and here you had put negative, it will bring problems. So you have to know from this stage, it is going to be positive or negative. So decrease in stock should be positive. So it will be 176 minus the 123. So that is positive 53. Then receivables increased. Increase in receivable means we kazi yako ni kuuza na kuna pesa unachukua. You just tell people you will pay me when you are okay. I have no problem. So it means your money is tied out there with the customers. You are selling on credit but not collecting anything. So you say is equals to, so that one will be negative. So it is this minus this one here. Then for payables, it was 100, it went to 156. Wewe uko na madeni na ulipi. So you have the money. You have the money with you. We assume, even if you don't have in accounting, we assume you have the money. So it should be positive. So it will be 156 minus the 100, like that. So increase stroke decrease is my BF. BF is the balancing figure. The balancing figure there. So I have to make it visible like that. So when I go back, inventory is an increase. So you will come here and say increase. It is increase or decrease? Sorry.
Decrease.
It's a decrease, eh? Yes, a decrease. So decrease in inventory, decrease in inventory there, while there was an increase in receivables, then for payables was an increase. Also, we had increase. We had an increase in payables. So payables went up that way. So I'll bring them here. So it's equals to, so inventory. So I just say is equals to, then I go to this side. Also, I could have, but that could have not worked. Also, that is equals to, then, sorry. Then receivables also is equals to, I go this side, I pick the 8, then I press enter. I just press enter. Then payables is equals to, payables also is equals to the 56. I press enter. So I don't even have to put the equal sign. You can just say is equals to, you select the other side, then you enter. Then I have to show you here in brackets, working 2. This is working 2. The same with these other ones. All of them, kindly examiner check working 2. Then I will bottom underline this, bottom underline. Then I will say here, cash generated from operations. So cash generated from operations. So cash generated from operations will be the sum of from 176 all the way to here. Then you close, you enter that. So that is positive 280. Then you close it by saying tax paid. You close this by saying tax paid. Tax paid, we can comfortably say here, working 3. So that one is always a working. I don't think if utaponyoka bila working. So working 3. So you come here and say working number 3. Working number 3. You can say taxation. Taxation is very simple here. Very simple. So for tax, you will say balance brought down. Balance, the balance brought down. Then tax for the year. So how much was your opening tax balance? Then how much were you charged for the year? So tax charge for the year. Tax charge for the year. Then you skip one line. No, the line you're skipping is going to be a balancing figure. The tax paid. Tax paid is going to be your balancing figure. And that is how we do taxation and interest, actually. Taxation and interest follows that format. So balance carried down. You'll have the balance carried down. There. So there we can have that. So let's fill in this. So balance brought down, check under current liabilities. The income tax payable at the start was 34. I hope that is okay. Then for the year, check P&L. So when we open the year, we are not paid tax of 34. Then tax charge in the P&L, you are seeing how much? How much are you seeing? Somebody? In our P&L? No,
47.
Yeah, 47 is correct. It is 47. Then the closing will help us. The closing will help us to get the tax paid. Closing, income tax payable closing, I can see 19. So here is 19. So to get tax paid, you will take, so here is equals to, it will be 34 plus 47 minus 19. So, no, that will not, when I integrate it, I'll let us show that, because tax paid should be negative. So you need it to make it negative. So I'll start with 19 minus 47 minus 34. So tax paid is 62. Tax paid is 62. Tax paid is 62. It should be negative. So that is what I need to take the other side. You go to the presentation. You say is equals to, in fact, the easiest way now to interlink is equals to, you go to that amount in the sheet 2. You click, sorry, in the sheet 2, I think this thing in a letter. Sheet 2 is there, 62, then you enter. It will come there. Then now, we are done with operations. Operations ends there. So you just bottom underline that. Bottom underline this, it ends there. So you bring the total here for the first time. So you say is equals to 280. You remove the tax so that you get 218. So 218 is the cash flow from operating activities. I would say that you call it A. Call it A there. Call it A. So we are done with operations unless someone has a question. You ask.
Can we subtract the interest?
Yes.
Can we subtract the interest after the tax paid?
You can subtract interest and even dividends. Jared, you can subtract interest and dividends as long as that is applied consistently. That is what the standard requires. And I started by telling you that examiner cannot penalize a student for capturing it in any. In fact, I don't know if I can get that standard, but you can check it later. In that standard, IS number 7, it will give you a guideline on how to treat interest and dividends. The standard says that interest and dividends can be captured in any of the three: operations, investing, or financing, provided the entity applies it consistently from time to time. So personally, I'll take it to financing, all the two, the dividends and interest. I'll take them to financing activities, but there is no harm as students subtracting interest and dividends at that stage. So Jared, hope that is okay with you.
Fine.
Good. All right, so let's go to investing. Investing activities. So investing, or which, oh, by the way, I was supposed to ask you. I have a whiteboard here. Was it your wish that I just do it on the board so that you can do the presentations, or the way I'm doing it? You know, I did not start by asking that option. Which one is better?
We are fine with the way you're doing it.
Oh, okay, so yes. So investing activities. So investing, when you want to work out investing in cash flow, you go to non-current assets. Kindly, let's go to non-current assets. Let us go to non-current assets. Let's go to non-current assets. So non-current assets, what are you checking? You check whether there was acquisition. You check whether there was disposal. If there is nothing much. Was there acquisition? Was there disposal? If yes, how much did you receive? How much did you pay? So go to the first non-current assets, PPE, property, plant, and equipment. Property, plant, and equipment. So that one, I will have to do a working. So have here working for, you have to reconcile that PPE. In any cash flow, PPE must always be reconciled from the experience. So PPE, property, plant, and equipment. And you have to be very fast. A balance brought down. Balance brought down. So balance brought down for PPE, you can be able to see 264. So we have 264. Then in note 1, additional information number 1, property, plant, and equipment held by that are items for plant and equipment and freehold premises. During the year, item of plant and equipment which originally cost 40 was disposed of, resulting into a loss of 6. Charged into admit, there is no problem. This item had a net book value of 28 million as at the date of disposal. So then it is okay. So you less disposal. So disposal, you less disposal. So you dispose at the net book value. You see those, the assets are recorded at net book value. So we assume that the figures appearing in the balance sheet, the 264, those are net book value. And therefore, when disposing off, you also dispose off net book value, not cost. Assets are recorded at net book value. So upon disposal, you subtract the net book value, which is 28, the book value. So you subtract the 28. Then you also less depreciation. Depreciation also, I want to check how they arrived at the closing figure. Our depreciation in note 2 was 43. So you must also subtract the depreciation, that 43. We're just checking the analysis of what could have happened. Then check under equity. When you check under equity, you will see revaluation reserve. At the beginning, revaluation was 1, 2, 3, 1, 2, 3. Revaluation was 67. Then it went down. Revaluation was 67, which went down to 36. So it means we have revaluation loss. Revaluation loss, which is 67 minus 36. 67 minus 36. So that will be 67 minus 36, 31. So, but it should be negative. So I should go the other way. It should be 36 minus 67. So that I get a negative figure. There was revaluation loss. So it affects the asset. Mostly those are what affects PPE. So if you adjust for this, when you adjust for that, you'll get that the amount, the closing figure should be how much? When you adjust up to that end, it should be 162. But when you check the closing, as per the examiner, according to the examiner, the balance carried down, according to Mr. Examiner, PP at the end is 327. Balance carried down is 327. And therefore, it means these people acquired. There was acquisition, the balancing figure. Why has it increased? Acquisition here is our balancing figure. The balancing figure here, it represents acquisition. So they acquire, and when you acquire, cash is going out, so it's negative cash flow. So 162 minus 37. So that is 165. That acquisition is what we are not being given. So you start with brought down, disposal, depreciation, then revaluation. Revaluation, make sure you always check it. Personally, I normally forget about it, but with experience, you can be able to. So they acquired PP worth 165. So we go back to our worksheet. You say cash received on disposal of PPE, property, plant, and equipment. Then cash paid to acquire
PP.
Cash paid to acquire PPE, property, plant, and equipment. So the cash paid to acquire is equals to this one, which we have just determined. You enter. Then cash received. So that you in a 5 and you're working. So I can do for it a working, but still in working for cash on disposal. Cash on disposal Cash on disposal will be net book value, NBV. Net book value they said was 28. This was 28. Then they lost. You subtract what you lost. The book value was 28. Then loss on disposal. Loss on disposal. They lost how much? 6. They lost 6. So it means these people received 28 minus 6. That one will be a plus because now I've already, so plus 6. So they received 22. So it's still under working for. So this one will be is equals to, workings here, is equals to this one here. They received 22. So you enter. So your attention is being drawn, working for. Working should be something serious. Working for, not 5. Well, working for. So that is our working for. So, then now under investing, you still stick to non-current assets. So PP, we are done with the 2. You must bring those 2 items, which we have captured. I like having these ones in bracket. So once I have negative, I just click, then I don't know how you call this. I'll reduce the zeros like that. So intangible assets tulipata amortization or impairment. So hiyo tulimalizana. Then we have financial assets through other comprehensive income. These are long term. So at the beginning, there's something I want to check about it. At the beginning, it was 10. Check equity, please. Check under your equity. Under equity, there is financial assets through other comprehensive income. At the beginning, this is a revaluation. The revaluation was 0. Revaluation was 0, then it went up to 2. So you will take the opening which is 10 plus 2, so that it becomes 12, but closing they closed with 22. So there was acquisition. So right there, acquisition, then tutafanya working lazima. We don't have option. Cash paid. Cash paid to acquire financial assets, financial assets. So financial assets. Unaenda like a hyphen, other comprehensive income. It will be clear to the examiner. So please tell the examiner to check our working number 5. Tell the examiner to check our working 5. So our working 5 is financial assets. Oh, sorry. Financial assets. OCI. OCI stands for other comprehensive income. Assets. Assets, other comprehensive income. So capture. I know we'll be on time. So balance brought down. Brought down for purposes of time. Brought down was 10. Then revaluation. There's revaluation of 2. Check equity. Under equity, it was 0, then it went to 2. So that was revaluation gain. Then acquisition. Acquisition is the balancing figure, BF. The balancing figure there. balancing figure. Where? Balancing figure, which we don't know, but closing, they closed with the 22. They closed with the 22. So 22, it means, so that is, you are carried down. So it means they acquired. And remember, acquisition is cash outflow, so it needs to be negative. So it should be 10 plus 2 minus 22. So they utilized 10 to acquire. So I will just go back to presentation is equals to this 10 here. You enter. Then I like bracketing for reasons which I don't know. There. And for your information, we are done with investing, unless you have a question. Investing is all about non-current assets, the acquisitions and
We have investment income.
Yes.
We have investment income, Mwalimu.
Oh, there's investment income. Yeah. Up there, there is investment income and a revenue. So that one should come here. Investment income. That one you just pick straight without any problem. Then it remains positive. That is 6. So thank you for that. So that one ends at that stage. Single bottom line. You go up your single bottom. That one. Then now you get for me the aggregate of this. So you can add the way you want. That one there is negative 147. I will call it B. I will call it B. Then finally, we are going to financing, which is our C. So financing activities. Financing activities. Financing activities. Financing activities. Financing, you go to equity and non-current liabilities, uko chini. So very fast. The first one is ordinary share capital. Please have a quick workings for ordinary share capital. So working 6. I want to beat time as well. So ordinary share capital. Ordinary shares. So you say balance brought down. I want to see whether they issued shares for cash. That is my main intention. So you'll say balance brought down in bracket, add ordinary and share premium. That is one category. So it is just 150 plus 0. If you check premium at the beginning, 150 plus 0, that is 150. So when we started the year, shares was 150. Your attention is being drawn to the last additional information. Shillings 50 million of convertible loan stock was converted to 50 million, shillings 50 million ordinary share capital at par. So you'll come here and say loan stock, they converted them into shares. Loan stock, they converted worth 50. So it means I was expecting to see 200, skip one line, carried down, according to examiner, carried down should be what plus what? 230, sorry.
30.
In bracket 230 plus 30. 230 plus 30 is 260. So this is 260. So now, it was supposed to be 50 plus 50, which is 200. It went to 260. They issued. So issue of new shares. Issue of new shares, sorry. New shares. And when you issue, you get money. Ukipeana shares, unapata pesa. You don't issue them for stones. So it should be a positive figure. So it should be 260 minus that minus this other one. So you get 60. They received 60. So you come here and say cash received on issue of new shares. Check kindly. Check for us working 6. So this is working number 6. Working 6 is equals to this one here. You enter like that. Then under equity again, ordinary done, share premium done. Revaluation, we had already captured on assets. Financial asset revaluation, we also captured. We have retained earnings. Utilize retained earnings to get dividends. So you say dividends paid, dividends paid. You're just spelling a dividends. Dividends paid. So dividends paid, please check working 7. Check working 7. Dividends is the decrease in profits. Decrease in profits. So you're working 7, you say retained earnings. Retained earnings. Retained earnings. So the retained earnings, you say brought down. So check for me the profit at the beginning. So brought down profits, retained earnings brought down was 91. So this is 91. For the year, check profit account, the profit after tax. Profit after tax for the year, we made a profit of 67. So it means I'm expecting a total profit of how much at the end? I'm expecting a profit of 158. But examiner has said that profit carried down, the examiner is saying retained earnings at the end is 121. Decrease in profit without communication is dividends. That is what you need to know, which I hope you are aware. When you see profit decreasing and there is no narration as to it, those are dividends. Those are, wait, when you have to do div paid, you know, we have to, dividends paid, that is the BF, the balancing figure. So is equals, it should be negative. So 158 minus 121. No, it should be negative. So it should be the other way around. Dividends paid is 121, closing, profit minus what it was supposed to be. So they paid dividends of 37. So you go back to your sheet here, then you say is equals to this one here, enter. Correct. Next item, under equity we are done. Let's go to loan stock. Loan stock, God is good. We check whether we paid or acquired more. It was 150. Then we converted 50, not 3. We converted 50 under qua shares. So 150 minus 50 converted is 100. So there is nothing. There is nothing on the loan stock, ignore. Let's go to current liabilities. Bank overdraft is a cash equivalent. Payables dealt with. Interest remaining. Income tax we dealt with. So the only thing remaining is interest paid. Interest paid, working 8. So that's the last item. So this is working number 8. That is working 8. Working 8, very fast. Working number 8, you say interest. interest paid. So how will my students be able to get the interest paid? Very simple. The way we did tax is the way you are supposed to work out that, the way we did taxation. So you come here and say, brought down, how much was payable at the start? So payable at the beginning for interest payable 1, 2, 3, 1, 2, 3. Interest payable was 3. Then for the year, so that was the amount at the start. For the year, the one which you are calling finance costs, So check P&L. For the year finance cost, we were charged 17. I hope you can see it. So it means the total is supposed to be 20. According to examiner, carried down, which have not been paid, is only 7. Sorry. Carried down is 7. So the total payable ought to have been 20. Why is the examiner talking of 7? Because they paid. So paid, BF, that is the balancing figure. That is the amount which was paid, which should be negative. So negative means it should be 7 minus this one here. So they paid 13. So you come here and say interest paid is equals to that one, enter. That is 13. And ladies and gentlemen, it ends. That is the full presentation. I'm almost done with the online class. Okay. So that is the end of financing. There is nothing else. So give me the aggregate. Give me the aggregate by giving us here. So you say is equals to this plus this one here. You enter. So it's come to positive. It's a positive figure. Call it C. Correct. C is talk evil. So bracket space C space bracket. Yes. So good. So net cash flow, or net changes in cash flow, whichever name you want. Net cash flow for the year. So net cash flow will be A plus B plus C, like that. So A plus B plus C is equals to, no, it should be straight below this, is equals to the sum of these ones here. So the net cash flow is 81. Then you come here and say cash and cash equivalents. Cash and cash equivalents brought down. Then you wind up with cash and cash equivalents carried down. So carried down like that. So that will be our final there. So this one, working 9, which is the last working 9, correct. All of which are working 9. So we go to working 9, working number 9. You say cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents. So you say here 2022. The other side, you say 2021. So we have financial assets at fair value. So financial assets at fair value. The short term, check under current assets, those are cash equivalents. So that one is 30. No, not 30. It is 65. The other side is 30. Then cash and cash equivalents, which we have been given, is 29. Then we have 0. Bank overdraft is a negative cash equivalent. This is just a working OD. Nobody will have issues with you unless mnajuana. So this is overdraft is 0. Okay. Then this is 22. Correct. So those are the cash equivalents. Those are the cash equivalents. So this one, sorry, overdraft should be negative, remember? So 0 pia ni kitu ya kuwekwa kwa bracket. Bila kuweka pia ni sawa. Bila tabaki tu hivyo. So have this as negative, have that one as negative. So is equals to, this one is equals to this plus that plus the 0, which is less. So that is 8. Then this one here is equals to this plus this plus the 0 minus the 0, whichever. So that one is 94. Sorry, Zoom, what is not happening? That is not presentable there. Yes. So I hope we have captured everything. Why are we having? We are having a variation of 5. Where is the 5 coming from? I'm seeing a variation of 5. Where is the 5 coming from? Somebody seeing the 5? I'm seeing a difference of 5. Because when we go here, brought down is equals to this one here, which is positive. You enter, which will automatically give you this one here. When you bring the 81, it should give you is equals to this one here, the 94. But you see that one is giving us 89, which is the variation of 5. So I don't know where the 5 is coming from. I don't know whether there's something we have not captured, the 5. But that is not.
Could it be,
yes.
Mwalimu, could it be the impact of that gain on financial assets at fair value, the 5, because that's the only 5 that is there.
Which one?
Under revenue.
Eh?
Gain on financial assets at fair value, the 5.
Iko wapi your financial assets at fair? The one appearing under current.
Under revenue.
Yes.
Under revenue.
Under revenue. Oh, yes. There is gain on financial assets at fair value. So that one should be. So financial assets at fair value, beginning, where's the beginning? Under current assets, the beginning was 30. Then there is a gain. But now the gain, we should talk on the opening balance. So we should take 30 plus the 5, which is the gain. I can just fix it here. It is true. So that here we can talk of 13. So I agree with you. Thank you, Joyce. That is, it is the 30 opening plus the gain. Then we compare with the closing. It's true. So it should be 35. So opening should be 13. It has adjusted itself. So it is 81 plus 13, which gives us 94. So it has reconciled. It has reconciled. So that is how we present cash flow. And by the way, there's something I need to know. Yeah, kidogo too. What happens with section 2? You know, people should know what happens. Do you do all the questions, or you do at least? What happens with section 2? Because you should be knowing by now.
You do at least 3.
You do at least 3, yeah? Yes, so please, at least 3. If cash flow comes, can you be able to attend? Vero menyamaza sana. Joyce, Jared, will you
Yes,
be
I can
comfortable?
attempt it.
Yes.
Right.
So,
But you're not promising that you'll do it.
yes?
I'm just saying we'll try.
Okay. So are you of the opinion we do another question on cash flow, or based on time? Or once I share this, you can use this one to revise, so that in the next class, probably tomorrow, we go to presentation of the financial statements.
Can you attempt one with the direct method or indirect method?
Oh, we can repeat using the direct method, eh? Vero?
Yes.
Yes, class, we agree.
Yes.
Can you do that tomorrow? Yes. Let's repeat it tomorrow using the direct method of presentation. It will be very important for us. Otherwise, we have to stop there. I wish you a nice day. Continue reading. So I'm going to share this in the group. I hope, you know, me, I'm not an IT person. Me, I'm a financial reporting. So I hope I've tried to your expectation. Ama, namna gani?
Iko sawa.
Iko sawa. Thank you.
You're
Have a
good,
nice
yes.
day. Allow me to log out.